Okay, so the next topic is job costing or unit and batch costing rather. Very simple topic, so you can expect simple MCQs as well. So let's have a look. What does it say? Different businesses, in order to determine the cost of their product or service offering, follow different methods of costing, uniform costing, techniques of costing, none of the above. Now, let me give you a small preview. What are methods of costing? It is a way as to how you find the cost for a particular industry. Techniques of costing is something that every industry can use. Now, what all form part of methods of costing? Job costing, unit and batch costing, process costing, service costing, joint products. All of these are methods of costing. What are techniques of costing? Activity-based costing, standard costing, budgets, marginal costing. All of these are techniques of costing. So, what is material, labor, and overhead? Material, labor, and overhead are basically elements of cost. Okay, so now they are asking us if a business wants to determine the cost, what do they follow? They will have to follow methods of costing. Okay, now second one, in order to determine the cost of a product or service, following are used. Techniques of costing, marginal, standard, no. Methods of costing, again the same thing. Then unit cost is applicable. Now, what exactly is unit cost? We'll have a look. First, let's look at the alternative. Let's see if we can make sense out of it. So, unit cost is applicable where product produced are unique and no two products are the same. Dissimilar articles are produced as per customer satisfaction. Homogeneous articles are produced on a large scale, and products made require different raw materials. Now, I'll tell you the correct answer is homogeneous articles are produced on a large scale. Unit costing is basically to find the cost of one unit. Okay. Now, when do you have to find the cost of one unit? When you're making the same product in large scale, that is the time. If you're just making one product or just one unit, you don't need to find the cost of a unit, right? You are already finding the cost of that particular unit, which is why the third alternative. Fourth one, in case of products produced or jobs undertaken are of diverse nature, the system of costing to be used. Now, if they are of diverse nature, meaning they are different, can you use process costing? I don't think so. Why? Because it is one product, one cycle broken down into uh, different smaller processes. Operating costing, this is actually the name for service costing. Job costing, the answer is yes. You are finding the cost of that particular job, which is why whenever they are very different products, you find them, and that is what the answer will be. Then fifth one, job costing is applicable to all industries regardless of the products or services. No. Is a technique of costing? No, it is a method of costing. Suitable where similar products are produced on a mass scale, and method of costing used for non-standard and non-productive, non-repetitive items. So here the correct answer is D. Okay. Then the sixth one, the production planning department prepares a list of materials and stores required for the completion of a specific job order. This list is known as, so this is a bill of materials. This is basically called bill of materials, where you list down all the items that are required to make a product. So it is almost like a ingredient list. It tells you exactly which ingredient is required and how much quantity to manufacture the product. So that is technically called as bill of materials. Batch costing is a type of, oh, interesting. Batch costing is a type of process costing, job costing, differential costing, direct costing. It is a type of job costing. It cannot be a type of process costing. Why? Because uh, it is any which ways not divided in multiple processes. It is a variant of job costing, because when you're doing multiple products of the same specification, then it becomes a batch. Okay. Then batch costing is similar to that under job costing, except with the difference that, so we have to find what is batch costing similar to. It is similar to job costing, but what it is different by. So that's what the question is. Uh, Job becomes a cost unit under job costing. Batch becomes the cost unit instead of a job. That becomes true. We then start finding under batch costing, we start finding the cost of a particular batch. Okay, which is why. Uh, the main points of distinction between job and contract costing. Now, quite honestly, you should not have this in your syllabus, because contract costing is not in your syllabus. So, contract costing was actually used for construction industries, still used for construction industries. Okay, but we'll still try to make sense out of it. So, there may be the length of time of completion. Is there a distinction between that? Not really. I don't think so. Uh, Big jobs. Yeah, both of them can have big jobs. Yeah. Uh, Job may not be that big as a contract, but let's see. Activities to be done outside the factory area. Yeah, that's true. So all of the above. Now, see, contract costing may take very long time. So it is as good as multiple years. They may be big jobs. Activities are to be done outside the factory area. In a job costing, you don't have to do that. So we'll go with all of the above. Economic batch quantity is the size of batch of production where average cost is minimum, setup cost of machine is minimum, carrying cost is minimum, and D says both. I will go with D. Both B and C. Setup and carrying both are supposed to be the minimum. That is the whole logic of EOQ and EBQ. Under EOQ, the ordering cost and carrying cost is the least. Under batch costing, the setup cost and the carrying cost is the least. So yeah, it's the one. So 7.5 minutes, not bad at all. I mean, yeah. Okay, so next topic is process. Now, what do we have? Uh, the type of process loss that should not be allowed to affect the cost of good unit. So normal loss is always charged to the good unit. The other kind of loss that you're left with is abnormal loss. So the answer has to be abnormal loss. 200 units were introduced in a process in which 20 units is the normal loss. If the actual output is 150 units, what happened to the rest? Abnormal loss 30 units. Same. 100 units are processed at a total cost of 160. Normal loss is 10%. Scrap units are sold at 0.25 each. If the output is 80 units, then the value of abnormal loss. Simple. Yeah. We'll first find the cost per unit, expected cost per unit. So expected cost per unit is 160 minus scrap value of normal loss, which is 10 into 0.25. And 100 units minus scrap units are 10. So 157.5 upon 90, and these are 10 units. Let me quickly check. 157.5 divided by 90 into 10. 17.5. C. When the average method is used in process costing, when they say average method, they mean weighted average. The opening inventory costs are subtracted from the new cost. No subtraction happening. Added to the new cost. Okay. Kept separate from the cost of the new period, again not happening. Averaged with other costs to arrive at a total cost. See, it is added to the new cost. I'll tell you why. Uh, One second. Yeah. So, if you notice, when we do a step number three, that is cost per unit, you do opening cost plus the current cost, right? This is basically adding the opening cost to the current cost, correct? So, which is why. Then, the fifth one, what do we have for the fifth one? Spoilage that occurs under inefficient operating conditions and is ordinarily controllable. See, what kind of spoilage is controllable? The one which is not controllable is called normal. The one which is controllable is called abnormal. So it has to be normal, abnormal spoilage. Then the cost of normal loss is absorbed by the good units produced, and the amount realized by the sale of loss units should be debited to the process account. Do we debit it to the process account? And no, we don't debit anything to the process account. Debit to costing BNL, no. Cost of normal loss absorbed by the good units. This is right. Let's read the fourth one also. Debited to costing BNL account, and amount realized by the sale of loss unit should be credited to the process account. So part of it is right. The normal loss is credited to the process account, but is it debited to costing PNL? No, the normal loss is not. The abnormal loss is. So be a little careful there. Okay. Then the value of abnormal loss is equal to cost of materials. No, it can't be the total cost. Yeah. The total process cost less realizable value of normal loss. This is your expected cost per unit. The expected cost per unit is this. This is not the value of abnormal loss. Total process cost less cost of scrap. No. This is basically your numerator of expected cost per unit. Total cost minus the scrap value of normal loss. It has to be the fourth one then. Total process cost less realizable value of normal loss. Total process cost less realizable value of normal loss less the value of transferred out units. See what happens under basic process account. We have either loss or transfer. So they did the total cost. They did the total cost less the scrap value of normal loss and less the transfer valuation. This is basically abnormal loss. Are we understanding? Inter-process profit is calculated because the process is a cost center. See, if a process is cost center, they are not worried about profits. So this is out. Each process has to report profit. Not necessary. I mean, yeah, but they're not necessary. The efficiency of the process is measured. Yeah, this could be it. The wages of employees are linked to the process profitability. Wages of employees are never linked. Their commissions, their bonuses, their commissions might be, but wages of employees never. Then comes in the ninth one. Under weighted average method, uh, the cost to complete the opening WIP is ignored. No, sorry, boss. We never ignore a cost. The cost to complete the opening WIP and other completed units are calculated separately. Now see, the opening stock valuation is calculated separately under FIFO, not under weighted average. So this is not right. The cost of opening WIP and the cost of current period are aggregated, as in added, and the aggregate cost is divided by the output in terms of completed units. This is what we do. Uh, a process account is debited by abnormal gain. The value is determined at expected cost per unit equal to the value of normal loss. Value of normal loss is scrap. It is not scrap. Cost of good units less realizable value of normal loss. This seems right. Cost of good units less realizable value of actual loss. No, we never have actual loss directly written into it. Equal to the value of good units less closing stock. Good units less closing stock. No, I think we'll go with B. The cost of good units less realizable value of normal loss. Further, Lean Labs develops 55 film using a four-step process that moves progressively through four departments. The company specializes in overnight service and has the latest drugstore chain as its primary customer. Currently, direct labor, direct material, and overheads are accumulated by the departments. The cost accumulation system that best describes the system Lean Labs is using is operation costing, activity based costing, uh, job order costing, or process costing. The answer has to be process costing. Why? Because it is a four-step process. Each of the process is accumulating their own cost. That is what you do under process costing. You have process one cost in process one, process two cost in process two, so on and so forth. Correct now? Then the 12th one, when compared with normal spoilage, abnormal spoilage arises more frequently from factors that are inherent in the manufacturing process. The factors that are inherent in the manufacturing process, they are not abnormal loss, they are normal loss. Is given the same accounting treatment as normal loss? No, they are treated differently. It's generally thought to be more controllable by the purchase department than the production department. I honestly don't even know what it means. Is not typically influenced by the tightness of production standards. Well, we'll go with the fourth one because I'll tell you why. I'll be honest here. The first two are not possible. The third one, honestly, I don't get what they're saying. So we'll go with the fourth one, odd man out. Genuinely odd man out. Then what do we have? Assume 550 units were worked on a period in which a total of 500 good units were completed. Normal spoilage is 30 units, abnormal spoilage 20 units. Total production costs were 2,200 units. Company accounts for abnormal spoilage separately on the income statement as loss due to abnormal spoilage. Normal spoilage is not accounted separately. We don't even account separately for that. What is the cost of good units produced? Simple. We'll find the expected cost per unit. So the expected cost will be 2,200. They haven't given a scrap value of normal loss, so we'll put down nil. And 550 units minus the normal loss, which is 30. And I think, yeah, this will give us cost per unit into the good units are 500. Let's see how much is it coming to. Uh, 2,200 minus nil divided by 520 into 500. 2115 B. And the last one. IC Limited usually uses process costing system and inspects its goods post manufacturing. An engineer noticed on 31st of May of the following. So goods completed is 15,000. So normal loss is 300, abnormal loss is 100. Unit costs were material 2.5, conversion cost was 6. Number of units that a company would transfer to its finished stock and the related cost of these. Now, you'll have to understand how this will happen. So, you have input of how much? You have an input of 15,400. Okay. Less normal loss, 300. Expected is 15,100. Actual is 15,000. So, there is 100 abnormal loss. Now you have incurred cost for all of those 15,400 units, boss. So your cost per unit will be 15,400 into 8.5. How 8.5? 2.5 plus 6. All of this will be your total cost on the numerator. They haven't given us any scrap value of normal loss, so I am writing nil. And over here, input minus the normal loss, 300. This will give us the cost per unit. 1 minute. Uh, 15,400 into 8.5 and divided by 15,100. This is the cost per unit and the valuation for finished goods. 1,30,033. They have 050. 15,000 units will be transferred at 1,30,050. Okay. So that's about it. And I'll see you in the next one. Now, uh, what does the MCQs for joint products and byproducts say? Let's have a quick look at it. So it says in a sugar manufacturing industry, molasses is also produced along with sugar. Molasses may be of smaller value as compared to with the value of sugar and is known as, if you have less or very low or no commercial value, those products are called as byproducts. Method of apportioning joint costs on the basis of output of each joint product at split off. Output, they are talking about units. Units is physical unit method. Next one, in the net realizable value method, NRV method, for apportioning the joint cost over the joint products, the basis of apportioning will be, so for NRV we do sales at final stage less the further processing cost. Let's find that out. Selling price of each unit of the, no. Selling price multiplied by unit sold, no. Sales value of each product less the further processing cost of individual products. No, according to me, the fourth alternative is stupid. I mean, in a method, how can you have two methods being the same? I mean, I just don't get that. I think it's wrong and stupid, but ठीक है. The main purpose of accounting for joint products and byproducts, this we have done in class. In my explanation, I remember one of the reasons why you want to do it is to figure out whether whether a product is profit making or not. Did you actually make a profit on that product or not? Because you don't know the cost. If you don't know the cost, you can't decide the selling price, or you will, if you have a selling price, you will not be able to decide upon the profit. Let's see. Determine opportunity cost, no. Replacement cost, no. Determine profit or loss on each product. But yeah, if I want to put this MCQ, what I would do is I would put down both. I would say it is to figure out profit, plus it is to figure out the selling price, and I'll give you the third alternative as both A and B. You know, something like that. This one's too simple. It's boring. But anyways, uh, what do we have next? Fifth one, under net realizable value method of apportioning joint cost to joint products, under NRV method, selling and distribution cost, is it added to the joint cost? No, they are separate. These will be part of further processing cost. Do you deduct it from further processing cost? No, but we deduct it from the sales value. Correct, na? When we are doing net realizable value, NRV method, we do sales at final stage less the further processing cost to get the NRV, right? So this will be deducted from the sales value. Which of the following is a co-product? Now, very interesting. We did not have anything on co-product. Just let me show you. Co-products, these are two or more products which are contemporary but do not emerge necessarily from the same material in the same process. So it's like lentils and rice, something like that. Now, they are both needed together, but they're not possibly made together. So on that note, diesel and petrol in an oil refinery, I think they can be produced from the same process. So we'll ignore that. Edible oils and oil cake. Now, edible oil is a separate process. Oil cake is a separate process. But let's go further. Curd and butter in a dairy. I think it's the same process. You'll have to heat up milk. Mustard oil and sunflower oil in an oil processing company. Now, mustard oil and sunflower oil in an oil processing company. I think this would be better than edible oil and oil cake, because once you've done the edible oil, then comes in the oil cake, but they are not, they don't go hand in hand. But mustard oil and sunflower oil in an oil processing company would go hand in hand. So we'll go with 6D. Seventh one, which is an example of a byproduct. Byproduct meaning low value, no value, very less value, something like that. Uh, Diesel and oil, similar values. Edible oil and oil cake. Now, this could be the right one. Let's see. Curd and butter in a dairy, no. Good values. Mustard seeds and mustard oil. Firstly, I don't think mustard seed and oil will ever create a byproduct. Okay. So, the most plausible one is edible oil and oil cakes. Now, some of you may be thinking, why am I solving it like this? Because I am trying to solve it from the student's perspective. You may have such doubts always, and if at all you have a doubt, the best thing to do is figure out all the other uh, options and then figure out uh, what is the best one out of it if you have more than one choices. Then try and go a little practical. I think you will be able to do well. Now, eighth one. Which of following method can be used when the joint products are of unequal quantity and are used for captive consumption? Very nice, huh? Good one. So when you're captively consuming, what method can you use? Technical estimates using market value of similar goods. This is one good one. See, because if you wouldn't have used for captive consumption, you would have bought the material from the market. And if you would have bought the material from the market, then obviously you would have to pay for it. So that much will be the value of captive consumption. Could be. Net realizable value will somehow not be fair if you, because you're reducing the cost as well. Physical units, unequal quantity physical units would be the worst one to do. Market value at split off. Uh, but if it has a further processing cost, then it will become a little mistaking. So I think we can go for technical estimates with market value of similar goods. Now, the ninth one, which of the following statement is not correct in relation to co-products? Nice. Uh, Co-products may also have joint products. Possible. Costing for co-products are done according to process costing method. Now, if you have one product, then yeah, you can do it as per process costing as well. I don't find a problem. Co-products do not have any byproducts. Not necessary. So as of now, this looks like an answer. Let's read further. Co-products are treated as a separate cost object for costing purpose. Yeah, they can be. So the best answer, co-products do not have any byproducts. 10th one. When a byproduct does not have any realizable value, the cost of byproduct, it's the same, yeah. The cost will always be borne by the good units, the main products or the joint products. Transfer to costing P&L, no. Byproduct cost is borne by the good units. Here we have an answer. Byproduct cost is ignored. My friend, no cost is ignored. Keep that in mind. And byproduct cost is determined taking value of similar goods. Now, the 11th one, what does it say? SG Limited manufactures two products from a joint milling process. The two products develop a mine support and commercial building. A standard production run incurs a joint cost of 1 lakh and results in 60,000 units of MS and 90,000 units of CB. Each MS sells for 200 per unit and CB sells for 450 a unit. Assuming no further processing work is done after the split off point, and the amount of joint cost allocated to CB on a physical quantity allocation basis. So you are going to divide the joint cost on the basis of physical measure. So it's simple. You have 1 lakh rupees of JC in the ratio of 60,000 and 90,000, which is 4 is to 6 or 2 is to 3. This is what it looks like. 1 lakh 60,000 and 90,000. 1 is to 1.5. Yeah. Each MS, and assuming no further processing is done. So 2 is to 3. So I think 40,000. Sorry, we are looking at CB. CB is 3. So it will be 60,000. My bad. K company manufactures two hair care lotions, Livy and Silly, out of a joint process. The common costs incurred are 6,30,000 for a standard production run that generates 1,80,000 gallons of Livy and 1,20,000 gallons of Silly. Livy sells for 240 a gallon and Silly sells for 390 a gallon. If additional processing costs, that is FPC, beyond split off point are 140 and 90 per gallon, the amount of joint cost of each production run allocated to Levy on a physical quantity. Again, they've come down to physical quantity. So we have 6,30,000 of joint cost in the ratio of 1,80,000 is to 1,20,000. So that's like 3 is to 2. This time they've asked for Levy. Levy is the first one. So just 3 is to 2 ratio. 1 second. Let me see how much is it. 6,30,000 into 3,78,000. Here is an answer. And the last one. For the purpose of allocating joint cost to joint products, the sales price at the point of sale reduced by the cost to complete after split off, that is the further processing cost, is assumed to be equal to, oh wow, sales price at the point of sale less the further processing cost is what it looks like. So it is assumed to be equal to NRV. Let's say joint cost. No, we have profit element yet. You are selling it at selling price. So when you reduce only the cost, there is a profit element in it too. So it can't be joint cost. Sales price less a normal profit margin at the point of sales. No, but then you have reduced the cost to complete after split off. You have reduced the further processing cost also. You have net sales value at split off. This could be right. Net sales at split off. Because whatever cost that they have put in at split off, they are putting it as net sales. So this would fit at split off. Total cost to can't be. So we'll go with net sales at split off. So I think this one is the right one. And this finishes our chapter. Let's start the next one. Okay. So the next topic is service costing. Let's begin. It says composite unit for a hospital. This stupid. We've done this. Patient days. Then cost of diesel and lubricant is an example of operating cost. Uh, Fixed charges, semi-variable costs, none of the above. So it will be an operating cost for the sole reason that for a transport industry, this would be the cost to operate a truck. So which is why it will be an operating cost. Cost unit used in power sector, kilowatt hours. We have a question on this. So not even reading the next the other options. Absolute ton kilometer example of composite unit in power sector, composite unit in transport sector, transport sector. Depreciation is treated as fixed cost if it is related to activity level. So if it is changing with the activity, then it is not a fixed cost. Related with machinas, again not a fixed cost. Influx of time, as in how old it gets, that much will be the depreciation. This one is the right one. Jobs taken under IT and ITES organizations are considered as, they are actually considered as a project. They're not batch work. It's not a contract. Not all of the above at all. Contracts are usually used with construction industries, but the IT industry calls it a project. In toll road costing, the repetitive cost includes maintenance, annual operating cost. No, see, this is how stupid the options can get. They're saying repetitive cost. How can an annual operating cost be a repetitive one? It is an annual cost, so it happens once a time. It's not repetitive. None of the above, both the above. So we'll go with maintenance cost. Then BOT approach means build, operate, and transfer. This so we have done. Yeah, come on. Pre-product development activities in insurance company include processing of a claim. No. Selling of policy. No. This is again not pre-product. Provision of conditions. This would be pre-product. Policy application processing. Of course not. So provision of conditions. This would be your uh, pre-product development. And I think we've reached the last one. Which of the following costing methods is not appropriate for costing of educational institutes? Batch costing. Um, they can do that, yeah. I mean, for every batch they can do it. ABC for sure they can do it. Absorption costing, yeah. The only thing that will odd man out is process costing because they are not divided into multiple processes, right? A school is not a multiple process thing, so which is why process costing would be the odd man out. And I think, yeah, this is done, and we have created a new high, 3 minutes and 40 seconds only. Yeah, so let's do that. The next topic that you have is standard costing. Now, under standard costing, you have some standards, basic standards, expected standards, this, that. So, we're going to discuss all of them. Okay. So, the first one, under standard costing system, the cost of the product determined at the beginning of the production. Cost of product at the beginning of the production. What will it be called? Direct cost. Predetermined cost fits well. The English fits amazing. Historical cost, no. Historical cost is the past. Actual cost can't be. The deviation between actual and standard cost is known as multiple analysis, variable cost analysis, variance analysis. We have our answer. Now, the standard which is attainable under favorable condition, if it is a favorable condition, then is when you will be attaining it, is basically called as a theoretically standard. This is usually very difficult to attain. The standard most suitable from cost control point of view. So the most suitable one is what you can expect. So that is your expected standard. Overhead cost variance is difference between overheads recovered on an actual output minus the actual overhead incurred. Fits amazingly correct. Fixed overhead cost variance, absorbed minus actual, what you got versus what you spent. What you get is absorbed, what you spend is actual. So that's what it is. Uh, then what do you have next? The sixth one. Uh, which of the following variance arises when more than one material is used in the manufacture of the product? So you have material price variance, usage variance, yield variance, and mix variance. See, price and usage you would have had even if you had only one variance, one type of material. Mix and yield actually arises when you have more than one type of material, but I mean, it's a little off, but we'll stick to mix variance. Why not yield variance? Because I'll tell you why. Because usage variance in absence of more than one material is also called as yield variance. But the mix variance can only and only happen in that one situation. Correct. So no, we'll have to stick to mix and not usage. Further, the seventh one, there was labor rate variance. I'm not doing it. You do it yourself. Controllable variances are best disposed of by transferring to. So the best way of a controllable variance is to not blame anybody. You know that you made a mistake. The best one would be to transfer it to costing P&L. Okay. Ideal time variance. This is under labor. Ideal time variance is obtained by multiplying difference between the standard and actual hours by actual rate. This is your labor rate variance. Difference between the actual hours paid and the actual hours worked by the standard rate. Correct. So you paid for 100 hours, but you got work only for 90 hours. The rest of the 10 hours are abnormal idle time. This fits correct. Let's see the third one. Difference between the standard and actual hours multiplied by this is your labor efficiency variance or time variance. So no. Oh, basic standards. Let's see. What are basic standards? Those standards which require high degree of efficiency and performance. We just did that. Guess and tell me what that is. Average standards that are useful in long-term planning. No. Standards which can be attained or achieved. We just saw this one as well. We just saw this. It is the fourth one. Assuming to remain unchanged for a long time. These standards do not change for a long time. That is what is a basic standard. So that's it. Good, yeah. 4.5 minutes, not bad at all. Let's keep going. We have, I think, a few more chapters left. Yeah. Next chapter is marginal costing, my personal favorite. Uh, let's have a look at the questions. What does it say? Under marginal costing, the cost of product includes prime cost. No. Prime cost and variable cost. Yes. Prime cost and fixed cost. No. Prime cost and factory overheads. No. So the answer would be prime cost and variable overheads. Basically, all variable costs here, and prime cost is a variable cost. Reporting under marginal costing is accomplished by treating all costs as period costs. No, not all costs are period costs. Eliminating the work in progress inventory account. We don't technically do that, I feel. No. Matching variable costs against revenue and treating the fixed costs as period costs. This is what we do. So variable cost is matched against revenue. That is where you get your contribution, and then all of the fixed costs are considered period costs written off, and then you get a profit. So this one is right. Including only variable costs in income statement. This is stupid. Don't even think that something is right away. Period costs are variable costs. No, variable costs are called as product costs. Okay. Period costs are fixed costs. Yes. Are they prime costs? Not necessarily. Overhead costs. Oh, this one is nice. You'll have to remember this, understand this. I'm going to give you a quick hack. So, under absorption costing and under marginal costing, what happens to the profit? If the units are same, units produced and sold are same, absorption costing profit and marginal costing profit will also be the same. But if units sold are more than production, Then marginal costing will give you a higher profit, absorption will give you a lower profit. And if sold are lesser, produced are more, absorption will give you a higher profit, marginal will give you a lower profit. Okay, now why? There is a whole derivation to it. Quite honestly, for something this small, I don't think it is worth. But yeah, you can keep it in mind. If the units produced and sold are the same, profit would be same. Units sold are more, and marginal costing will give you more profit. If units sold are more than the produced. That's what I said. Units sold are more than the produced, then marginal costing will give you more profit. If the units sold are less, production is more, then absorption will give you more profit. Okay, keep this in mind. They are the same, so profit will be the same. Marginal costing is equal to production absorption. When the sales exceed production, then marginal will give you higher profit. Where do we have it? Marginal is oh sorry, uh, we have it in the first one itself. Marginal is higher than that of absorption. Then comes in the next one. The main difference between marginal costing and absorption costing is regarding the treatment of fixed costs. Always and always only that. See, because prime cost remains the same, material is part of prime cost, variable costs are always treated the same. The only problem or the only difference in the treatment is how you consider your fixed cost to be. That's the bigger challenge. Okay, so here the answer is fixed cost. Under the PV ratio, the term profit means the sales proceed in excess of total cost. No, that is not the profit that we talk here. Means the same thing as it is generally understood. Is a misnomer. It is in fact refers to contribution, that is sales revenue minus variable costs. That is the right one, because we do contribution upon sales, but the question is called formula is called PV ratio. I'm sure we have discussed this in class as well. I don't know if you remember this. Factors which can change the break-even point. What is break-even point? Fixed cost upon contribution per unit. So in either the fixed cost or selling price per unit, variable cost per unit, or contribution per unit. Any of that changes, the break-even point will change. Change in fixed cost, yes. Change in variable cost, yes. Change in selling price, yes. All the above. We have the answer at all the above. If PV ratio is 40% of sales, then what is the remaining 60%? It is variable cost. No need to check. PV ratio is 0.6 and profit is 9,000. Margin of safety. MOS, we know it is profit upon PV. So 9,000 upon 0.6, I think this should be 15,000. And very good, yeah. In 5 minutes, 6 minutes, we have completed all of it. So that's it in this chapter. Let's start the next one. Okay. So the next chapter that we are doing is budgets. So let's start. It says the first MCQ. If a company wishes to establish a factory overhead budget system in which estimated costs can be derived directly from the estimates of activity level, it should prepare what? Now try and understand what they're saying. They want to make a budget where with one activity they can derive the value of other activities. So you have at one activity and then you are doing other activity levels budget. What do you do? Where do you do this? You do this in case of flexible budgets. Remember, under flexible budgets we used to have a budget at one level and we used to make budgets at different levels, correct? So it is that. So we'll have to see if we have flexible, you do. Now, what is a fixed budget? It is just one budget stayed there, that's all. Cash budget, you don't have it. I think you have it in your reference syllabus. And master budget is all budgets put together. We have a question on that. The classification of fixed and variable costs is useful for preparation of master budget, doesn't matter. Flexible budget, yes, does matter. Because the idea of flexible budget is based on this, that it has to be the fixed costs do not change and the variable cost changes with the level of activities. Okay. Uh, Budget manual Is a document which contains different types of budgets to be formulated? No. It contains the details about standard costs of the products to be made? No. It is setting out the budget organization and the procedures for preparing the budgets, including fixation of responsibilities, formats, and records required for the purpose of preparing a budget and exercising budgetary control. This is your right answer. See, a budget manual is an all-inclusive book. It's the Bible as to how to make the budget, what budgets to be made, who is to be made, who will do that, etc., etc., everything. So that's what a budget manual is. Okay. Now, the budget control organization is usually headed by a top executive, which is known as general manager. No, they don't do that. Budget director or budget controller. This could be it. This could be it, but we'll wait. Accountant of the organization, definitely not. None of the above, no. I'm going to go with budget controller. So he's the one who's responsible for looking after everything related to budget. Okay. Now, this one is nice. I like this one. See, understand what does it say? A favorable budget variance is always an indication of efficient performance. Do you agree? Give reason. Now, see, it is not always an indication of efficient performance. I'll tell you why. Because not always and always you would actually be consider a favorable variance as good. Because many a times what happens is you may actually have drawn the budget wrong. You may have given too much in the budget, and it was way too easy to achieve, and which is why it was a favorable one. So it may not always be a case where a favorable budget variance is um, an efficient performance. No, but let's look into the details. What are they saying? A favorable variance indicates savings on the part of the organization, and hence it indicates efficient performance of the organization. Could be. Under all situations, a favorable variance of an organization speaks about its efficient performance. No, this is not true. It is not under all situations. No. A favorable variance does not necessarily indicate efficient performance because such a variance might have been arrived at by not carrying out the expenses mentioned in the budget. Fairly possibly. So we'll go with this. Then, what do you have next on the sixth one? A budget report is prepared on the principle of exception and thus. So, what do you mean by principle of exception? So, it means that if everything is going right, they are not concerned about it. They don't want to have a look at it. See, because you've put in a lot of time planning it. And if the planning has gone right, great, yeah, you don't do much about it. You don't go further. You don't have to over ponder as to what went right and how, why did it go right and etc. If it did go right, great. Yeah. So now uh, when they say exception, it means you are reporting what has not gone right. Okay. So now let's see what it says. Only unfavorable variances are shown. Only favorable variances would be shown. Both favorable and unfavorable variances would be shown, and none of the above. The answer is C. Both of them would be shown. See, because anything that is going wrong, unfavorable, you need to know. But anything if it has gone very very right, even that has to be taken care of. So that is why the favorable variances are also reported. Purchases budget and materials budget are same. Now, purchase, so the material budget will actually tell you how much you need to consume, and the purchases budget tells you how much you need to buy. So purchases budget is a budget which includes only the details of all materials purchased. Okay. Purchase budget is a wider concept and thus not only includes purchase of materials but also other items as well. That's not true. You in the purchase budget you only look after the materials that you're going to buy. Purchase budget is different from material budget. It includes purchases of other items um, only. Only other items. Okay. And then the D part says none of the above. Now we will have to actually figure out. So there is no obvious answer to this. So let's redo this. None of the above. Let's keep that for a while. Purchase budget is different from material budget. It includes purchase of other items only. Uh, let's think over it. I think we can cancel out the first one for sure. A is not the answer. Let's talk B again. Purchase budget is a wider concept and thus not only includes purchase of materials but also other items as well. Okay. And purchase budget is different from materials budget. It includes purchase of other items only. So it can't be the only one. So we'll go with B. On what exception? That it is not just about purchases, but it is also about the purchases of other materials as well. Okay. So purchase budget would have everything to be purchased.